Welcome to another October 3 Pension Finance Update. I'm your host, John Lowell, and with me today, as usual, is Brian Donahue. Brian, this has been a pretty good year to date for pension finance, hasn't it? Can you comment on that a little bit?
Yeah, John, we're only 2 months into 2023, but it looks like through February, we've seen some incremental improvement in pension finances this year, which is encouraging. This comes on top of 2022, which was a good year for a lot of sponsors, and 2021, which was a very good year. So we're seeing the momentum of improved funded status continuing into early 2023. Which, is good news for sponsors. We think a lot of plans are maybe better funded than they really understand at this point. And so getting a handle on your 2023 valuation results, understanding where you are, and then projecting forward, we think there's good news and good opportunities for pension sponsors as a result of the good news.
That's great. And I noticed you mentioned that 2022 was actually a good year for pension finance. So that was because despite virtually every asset class having a decline, interest rates went up more than enough to offset that. Isn't that right?
That's what we're seeing. That's the pattern we're seeing across plans. Yes, double-digit asset losses, which, nobody enjoys that, but a big increase in interest rates pushed liabilities down 20% or more for most plans. So yeah, in the end, 2022 was actually a decent year for a lot of sponsors. This year, we've had 2 months. January was a good month for stocks. Interest rates went down. And then in February, we see the reverse. And you think we're sort of back to where we were at year end, but incrementally, we've got positive stock market returns for the year. And so we think most plans are likely have picked up a couple percent in the first 2 months of 2023.
That's really good. So plan sponsors, what should they be thinking about now? Do they have some opportunities coming up, particularly those plans that are frozen and are looking to get to their exit?
Yeah, well, anybody who's been in the pension business the last decade understands that sponsors are settling liabilities. They're doing lump sum windows. They're doing annuity purchases. The motivation here is to reduce overhead costs. The improved funded status that we're seeing the last couple of years is just fuel for that continued movement. So we don't expect sponsors to be slowing down and settling liabilities, particularly frozen plans, right? As you get close to full funding, there's really no reason not to wind the plan up at that point.
Very good. Do you have any closing thoughts?
I think, for a lot of plans, maybe smaller plans especially, this is something we said at the end of 2022, is understand where you are. You might be in a better situation than you think. Everybody understands, that the overhead costs for pensions are such a burden that creates urgency to try to get out of the pension system if you've got a frozen plan. And the improvement we've seen in the last couple of years is all great news for sponsors that can maybe get out for a lot less than they could have a year or two ago.
Brian, those are excellent insights. And for all our listeners, thank you for joining us this month. We hope to see you again next month. Until then.
Thanks, John.
So much.
Thanks.